Part 2. The Production of Capital. Chapter 3. The Measurement of Capital. What is capital? Money is the most common understanding of capital. Yes, all money is capital, but not all capital is money. Money is but one form of capital. Capital includes all forms of property, of which money is one form of. I define here that the capital of property is measured as the most recent market price paid of that property. This is commonly considered as the market value or fair value of property. Capital shouldn't be seen as material things, but as an attribute of material things. Capital is synonymous with wealth and net worth from an accounting and financial perspective. To have a lot of wealth, net worth, or capital means to have a lot of highly priced property. Money, as property, has capital equivalent to itself. In quantifying the capital of property, money is used as a reference. It is a unit of capital, like how Celsius serves as a unit of temperature. What's the capital of 50 $100 bills? It's $5,000. What's the capital of a bank account with $45,000 deposited? It's $45,000. What's the capital of a house recently purchased at $200,000? It's $200,000. What's the capital of 50 shares of a company that recently sold at $1,000 a share? It's $50,000. If you own this money, bank account, house, and company shares, you own $300,000 of capital. In defining capital, I introduce the concepts of property, market, and price, so I will define these here. What is property? Anything with an owner who, or what, has a property right to it. A property right being the exclusive right to use it as enforced and in compliance with the law. Governments serve to establish and enforce these rights and laws. For example, if you own a car, you are allowed to use it however you please, as long as you don't go over the speed limit, don't run people over, register it, pay taxes on it, and comply with all other relevant laws. Someone else cannot use it however they please because they do not have a property right to it. They don't own it. If someone does try to use it or take it without your consent, you can enforce your property right as licensed by the government, i.e., use force in accordance to the law, or you can appeal to the government, which will enforce your property right to the car the best they can, i.e., police will investigate and try to recover it, and the government will prosecute as appropriate. Nearly everything is a form of property. Money, food, clothing, furniture, cars, land, houses, televisions, computers, smartphones, machines, factories, jewelry, commodities, securities, contractual obligations, licenses, entire businesses, and your own body are examples. What is the market? The market is no mystical or undefinable entity. It is simply the collection of property owners who use and exchange their property according to the rule of law. What is price? It is through this exchange of property, where price is defined as the ratio of property exchanged between two property owners. Usually money, just another form of property, is exchanged for goods and services, defining the price paid of those goods and services in terms of money. For example, $2 can be exchanged for a sandwich, defining the price of that sandwich at $2. Services are a contractual use of property, such as temporarily borrowing and using property for personal use. How do we properly measure capital, the price of property? Accounting is the tool of measurement for the capital of property, like how a thermometer is the tool of measurement for the temperature of materials. There are two dominant accounting methods of measuring capital: historical cost accounting and fair value accounting. Historical cost accounting assigns the capital of an asset, another word for property, as the price paid by the owner of that asset. Fair value accounting assigns the capital of an asset as the current market price of similar assets. Historical cost accounting makes more sense for illiquid assets like factories, machines, or customized forms of property, while fair value accounting makes more sense for liquid assets like currency, commodities, and securities like stocks and bonds. Unlike liquid assets, there is not an active market for illiquid assets, and so the price paid by the owner usually represents the most recent price paid by the market for such an asset. Essentially, fair value accounting extrapolates the capital of an asset based on the current market price of similar assets. The less similar the asset, the less reliable and accurate that extrapolation becomes, and so the less appropriate it is to apply fair value instead of historical cost. There are specific consequences to how capital changes when adopting either method. If quantifying capital strictly based on historical cost accounting, then the capital of property does not change until it is exchanged. If quantifying capital strictly based on fair value accounting, then capital changes when the market price changes or the nature of the property itself changes. Accountants have a principle called the revenue recognition principle, which means that revenue, an increase in capital, is not recognized until property is exchanged or delivered. I will not be adopting this principle in quantifying the change in capital. Instead, I will be adopting a fair value method of defining capital. Subsequently, capital changes when the nature of property changes or the market price of property changes. Unlike historical cost, capital is instead conserved in exchanges except to the extent an exchange changes the market price of property. The purpose of the revenue recognition principle is to provide strong proof of the capital of property, as well as making sure that the property was actually delivered in exchange for the revenue. I adopt a fair value method of accounting for capital because I will argue that the capital of property is ultimately determined by its internal and external organization, which readily change regardless of the transactions among property owners. The exchange of property is simply the point of measurement of this capital. The entire field and profession of accounting deals with what is the proper way of quantifying capital. There are no exactly agreed upon principles because there are no exactly agreed upon goals of accounting. There are a range of different goals for measuring capital, such as tracking the productivity of management and employees, predicting future productivity of a company, knowing what types of property and obligation a company owns, determining how much to pay back to the shareholders in terms of dividends, determining how much to pay in taxes, etc. Different ways of measuring capital can be more or less useful for each of these goals. Given these challenges, I adopt the definition of measuring capital as outlined before, that the capital of property is measured as the most recent market price paid of that property. I will be adopting those principles of accounting that I believe currently best justify the principles with regards to the production of capital.